Good morning. For Traders Exclusive, this is George Kachuk, or RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. Well, in the equity markets, we have a new bull market. And what I refer to when I say new bull market is a lot of the financial press and all the financial pundits and gurus keep telling us how we're 7 years into this bull market and it's long in the tooth and it has to end. Well, I disagree, and I'll tell you why I disagree for a few reasons. And also, one of the other things I want to mention, and now the financials have joined this market. Basically, everyone's saying that we haven't had a reset in this market. But again, I disagree. In 2011, it was very short-lived, but we did have a 20% correction. That was a pretty tough year to make money. And similarly then, in March of 2013, we did break into a new high in the S&P 500, taking out the 2000 high, moving higher. And now, actually, for this whole last year, probably more like 14 or 16 months, we've just moved sideways, but there's actually been a bear market underneath. And what I'm referring to is, so the S&P has only corrected 15%, and everyone says, well, you need a 20% correction. That's the definite mark. Otherwise, it's not a bear market. But if you look underneath the hood, we can look at a lot of different sectors, and they indeed have been in a bear market. For instance, the Russell 2000 corrected about 27% from peak to bottom. The S&P mid-cap, the S&P 400, corrected about 22%. We saw the transports correct about 31%. The XLE, the energy sector, corrected 50%, while crude oil itself corrected 77%. The financials, XLF, corrected about 23%. The biotech sector corrected 50%. If you look at the ETF, the IBB, and the material sector, the XLB, corrected 30%. So you see, we had a lot of really big corrections underneath the hood. However, the indexes held up. And there's a reason for that. There was a little bit of a search for yield, so a lot of money flowed into big cap names that are just dividend payers, whether it be the utilities or the staples, and that kind of kept the indexes up. But generally speaking, there was a correction going on underneath that market. Now, as we have the markets hitting new highs, we still don't see any euphoria. No one believes it. Everyone's saying we're 7 years long, we have to correct. And technically what we've also seen is like a pretty classic setup, meaning with the Brexit washout. Go back to our video a few weeks ago, we talked about the Brexit, how it's not the end of the world. Sure enough, we had a few-day event where the markets corrected 6%, and since that time, the S&P and NASDAQ basically been up 6 weeks in a row. Now again, we're moving a little sideways. We're pretty much poised and set up to continue higher. Now, it's not going to be a smooth, easy road, just continue on higher. There's going to be a lot of shakeups along the way, and you can expect that. But not until you see some really terrible selling going on. You got to believe the trend is up. And what we're seeing is a lot of fund accumulation over these last 6 weeks. Now, specifically last week, we saw a big move in the financial sector. After the second monthly surprise in jobs reports, the yields shot up, and all the banks and financials started moving higher, with the idea being that maybe the Fed will raise rates. Now that's a tough one. You don't know what the Fed's going to do because they themselves aren't really sure what they're going to do. However, you can look at what the stock charts are telling us, and we see that the XLF broke into an 8-month high. Similarly, if we look at the banking sector, it got above its 200-day moving average. That's the large banks. That ETF is the KBE. And with that, we saw Bank of America, BAC, getting above its 200-day. This morning, we see Citigroup trying to get above its 200-day. Same thing we see with Goldman Sachs or JP Morgan, similar type situation. Then we have a stock like Wells Fargo, still below its 200-day, but that's something also you can take a look at. If we look at regional banks, the regional banks ETF is the KRE. That's also doing very well, shooting up. And we have notable stocks like MB Financial, symbol MBFI, pretty much at I think it's about a 10-year high right now. And then we have stocks breaking out like Eagle Bank Shares, that's EGBN. That's basically breaking out on Friday and still in that pivotal zone this morning. Other notables in that space are Western Alliance Bank, symbol WAL, or Home Bank Shares, symbol HOMB. So those are things to look at. Similarly, in this financial sector, we see the same things with insurers. We saw Lincoln National, symbol LNC, breakout. And then we saw in the broker-dealers, stocks like Charles Schwab and Morgan Stanley also moving on the news. So, threw out a lot of names at you. In summary, consult your financial advisor if any of these trades are for you. None of these are buy recommendations. These are things that you should be looking at. Keeping in mind now also that the market right now is being led by good groups, meaning the It's the technology sector, the XLK, the consumer discretionary, the XLY, the healthcare sector, the XLV, and now we have the financials joining in, the XLF. All points for a very good market going forward until proven otherwise. So as always, let price and volume be your guide. This is George Kachuk with RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. Have a great trading week.